Today, the International Energy Agency is set to hold an emergency meeting among consuming nations to discuss a new release of strategic reserves. Major consumers will try to seek ways to compensate for possible Russian supply disruptions, as well as to increase supply in order to cool soaring oil prices. The United States has already resorted to similar steps. US President Joe Biden announced the plan to release 1 million barrels of oil a day from the US Strategic Petroleum Reserves over the next 6 months. This is the biggest release of oil reserves in the US history. OPEC and its allies are also preparing to raise output. The oil-producing countries agreed to add 432,000 barrels per day in May. Earlier, Saudi Arabia and the United Arab Emirates signaled that OPEC Plus would not bow to the pressure of Western countries, led by the United States, to pump oil faster. The organization decided to stick to its previous production plan. Given the situation in one of the world's largest consumers of energy, the decision seems to be right. According to recent data, China's manufacturing activity has noticeably shrunk. Both sub-indexes measuring factory output and new orders came in at the lowest level since February 2020, while export sales dropped at the quickest pace in 22 months. China's Caixin Manufacturing Purchasing Managers Index fell to 48.1 points in March. The indicator slipped into contraction zone mainly due to epidemiological threats that forced Shanghai to impose the most extensive lockdown in the last 2 years. In the face of weaker demand, Brent crude oil futures remain scared to the downside. Thus, the quote settled below $105 per barrel. The asset has lost about 15% for a week and a half. Despite its rather significant decline, this movement can be seen as a correction from the medium-term uptrend. As for possible pivot points, traders consider 2 levels. The first one is the psychological level of $100, and the second level is 98.95, the local high posted on March 16. This means that the quote may well reverse at these levels and resume its bullish run. Oil prices are likely to gain value after the situation with Russia's decree on ruble settlements for gas becomes clear. European countries refuse to switch to rubles in gas payments. In response, Russia threatens to turn off gas supplies to Europe. Today, natural gas prices surged to 3-week highs following the release forecasting below average temperatures in northwest Europe. This means that utilities need to fill the storages, especially after an unplanned outage of Norway's natural gas fields. Meanwhile, the Russian ruble is likely to end the week with gains. According to analysts, the dollar-ruble pair continues to behave in an unusual manner and does not always show correct values. There is still a discrepancy of about 10% between its exchange rate and the interbank market value. The quote has been trading within a range between the levels of 82.50 and 85.00 for the 3rd day in a row. Apparently, traders are waiting for some news drivers. Gold futures managed to resume growth. As a result, the yellow metal jumped to the level of $1,950 per troy ounce. And nevertheless, it's still too early to talk about a change in market sentiment, as gold prices have spent the last 2 weeks in a range limited by the levels of $1,894 and $1,966. The current price movement is also within the specified area. Only after the price breaks through one or another boundary of the 1894 and 1966 channel on the 4-hour chart, it will be possible to talk about a trend change. Until then, the metal is expected to further move sideways, and gold prices may gain momentum on today's US jobs data, which will help determine the pace of the Fed's monetary policy tightening. And that's all for now. We continue to learn developments on financial markets. Subscribe to our channel and follow news with us. See you in our next release.